All right, welcome back to the Expat Files. Today I have a special guest, a good friend of mine. Chris Macintosh is the main writer and editor and analyst for just an outstanding newsletter. You'll see a link in it below the description here. It's called Capitalist Exploits Insider, aptly named. And as a guy who's in the newsletter business for a number of years now, I can tell you this is my very favorite one. Anytime Chris writes something, I drop everything the moment it hits my inbox and check it out. So Chris is here to talk to us about what he sees going on in the world today, and also to share some of his experience internationalizing his own life and some of the trials and tribulations that you've been through over the years. And so welcome, Chris. Thanks very much for taking the time to talk to us today.
It's a pleasure to be here. Good to see you, Jane.
Good to see you as well. Yep. So I'm going to let you kick it off. I know you're following something. I hear this story talked about in the social media sphere. It's obviously not unknown what is happening in terms of capital allocation. But why don't you go ahead and tell people what you're watching? Because I think this may be the biggest story of what's taking place in financial markets right now. And not enough people are taking it seriously, in my opinion.
Yeah, so I'll preface what I'm going to share with your readers or your listeners or your viewers with the statement that I think most are actually quite familiar with, which is to say we are witnessing the end of an era of Western dominance in culture, social, political, military, and certainly economic prowess. The path from that to something new is going to be chaotic. It's going to be volatile. It's going to have a whole lot of unknowns. What is known, or what can be fairly accurately determined, is the path of trajectory. And if we study history, we can see that there are phases, or there are events that transpire which lead into and accelerate a collapse of any particular system. And so the system that we have been living under, and that we are still living under, is under extreme pressure. We all know about the World Economic Forum and the "you own nothing and be happy" and all these sorts of. Now, these are all of these narratives and these desires and these objectives are actually fairly consistent with an end of empire type of structure. It's one whereby you realize that if you don't change the structure, it's going to collapse on itself anyways. And so one could argue that it's better to essentially commandeer it and steer the collapse and retain your dominance and power. And that's essentially where we're at now today. What I wanted to share with viewers, just because it's going to be probably front and foremost in terms of their own financial lives, so we won't necessarily cover where one might live and so on and so forth. But you'll see from the way that we allocate capital within Glenorchy Capital, our asset management firm, as well as the publication business, where we talk about what we are investing into, you'll see that our strategies and our sector allocations and geographical allocations will tie in with this theory, if you will. And what I wanted to point out was essentially risk. So when you have a system under stress, it can be under stress for a long time, right? You and I could go to the gym and we could put ourselves under stress, but nothing's going to happen unless we go beyond what our bodies can actually tolerate, okay? So for example, you normally go and squat, I don't know, 90 kilograms, or I don't know, you guys work in pounds, but if you squat some number and that's normal for you and you can do 10 reps, then you're fine. And if you go and you say, okay, I'm going to do 20 reps today, you're now putting yourself under an exceeding number of stress. At that point, you have a higher probability and a higher risk of something going wrong, either failure, or like failure as in your body can't actually do it, or your body actually fails and you tear a muscle or you collapse or something of that nature. So monetary systems are exactly the same. Economic systems are exactly the same. But what you get is a concentration of risk at the ends of these phases. Now, I don't know exact timeframes, but what I can show to you is the concentration of risk that we have today. And this is going to be true for many people who unknowingly are invested into this concentration of risk. They're unknowing because they have their 401k plans, their IRAs are in many instances simply allocated towards some of the large institutional players, whether it be your Fidelities or your State Streets or your BlackRocks or your Vanguards, or there's a whole room in them. They're all roughly the same insofar as they are aggregated capital, what we call passive capital. For anyone who wants to go and look into some of the machinations of why this is so risky, I'd research and look up a gentleman, friend of mine, Mike Green, who's done a lot of work on this, and he talks about this passive flow and how dangerous that is and how it's a systemic risk. Anyway, the point is, if you think about it logically, what happens is you'll be earning your salary every month, and a certain portion of that maybe goes towards your pension. And so it goes into these funds, okay? It just gets allocated away. It's 10% or 5% or whatever it is, okay? That capital is typically going into these large institutional, quote unquote, passive blocks. Where that gets allocated, we can actually see that in the markets where it is currently being allocated. It is predominantly being allocated towards US equities, number one.
Mavericks Project is a private community focused on powerful connections, trusted information, and time-tested solutions to create and preserve wealth during our epoch of extreme change. The Mavericks Project was born out of the social, economic, and geopolitical schism that kicked off in 2020. A small band of contrarian misfits spent the lockdown years observing problems, analyzing the implications, and plotting solutions. Now, several times a year, we Mavericks get together in fun and fascinating locations to talk about solutions to the social dangers to your family's safety and how to avoid them, the increasing state surveillance and how to negate it, the rapidly declining U.S. empire and how we want to position for what's coming next, the risks to your family's generational wealth and how to protect it. If you think you have what it takes to be a Maverick, this is your chance to come make new and better friends with some of the most accomplished people you will ever meet. Join us from November 4th to 7th in Dallas, Texas for 3 unforgettable days of action, discussion, and answers. The link for the event, along with all the details, is below this video.
Secondly, within the US equity markets, the structural breakdown of where it gets allocated typically on what's called a market capitalization weighted basis. In other words, if you've got a company that's a $2 billion company and another one that's a $1 billion company, it's going to allocate twice as much to the $2 billion company as to the $1 billion because of the weighting of that particular company. What this has meant is that more and more capital is being allocated towards companies that are larger, i.e. NVIDIA being the most extreme example of all of this, but the Mag 7 in general now accounting for what is the largest percentage aggregated capital within the S&P 500 as we've ever had before. Now, I'll give you a quick, this is all might sound to people like, oh, well, there's no, give me some reason why this could end. Why does it need to end now? So again, we don't know when it ends or why it ends or what the particular straw that breaks the camel's back happens to be. But what I can give you is some historical numbers. So if we go back to 1989 and the Japanese stock market, which at the time was the poster child of the world, right? And we had all these narratives that Japan was going to take over the world. Japanese businesses were studied in MBAs in Harvard, and Japan was the apple of the world's economic and financial eye. What we had in 1989 in terms of numbers is that the stock market weighting in terms of what's called the MSCI World Index, which is your global equities. As a percentage of global equities, Japan's stock market was weighted at 40 to 45%, okay? At the same time, Japan's GDP was 15% of the world economy. So the size of their economy, actual productivity was 15%. yet the valuation of their equities was 40 to 45%. So you can see the disconnect, right? So the Japanese equities were massively overvalued relative to the size of its actual economy. Now, come fast forward to 2025, Japan's stock market today is about 6 to 7% of the MSCI World Index. It's much more in line with its actual GDP share. All right, things tend to revert back to the mean. I point this out because today in the US markets, as of 2025, US listed companies account for roughly 64% of global stock market value. Okay, with the S&P 500 constituting 51% of that. And you can say, okay, well, what's US GDP? US GDP 24 to 2025 is 14.8%. Close enough to the 15% that Japan was. So Japan, the bubble that everybody talks about that crashed, that blew up in 1989, Japan was 15% global GDP, 45% stock market of global stock markets. US is a 15% GDP, and it's 64% global stock market value. Now, one could argue that's because they have the hegemony of the dollar and maybe the like biggest military might. All of these things are true and accurate. What I'm pointing out is that there is a risk here that is extreme, and people don't understand that they are inadvertently investing into it without even knowing that they're investing into it. Because your average portfolio, whether it be a pension fund, mutual fund, things of that description, typically are on what's called the risk parity trade, right? Jane, so you know about that. It's your 60-40 roughly equity bond split. So your financial advisor, when his pinstripe suit, is going to tell you that you should have roughly 60% equities and 40% bonds. Now, we could cover bonds and why you should absolutely not own bonds. And as I write this, I'm actually watching European bond markets going up in flames. But the 60%, that aggregated capital is that 60% is a huge problem. Now, within the 60%, like I said, you've got 51% of that is S&P 500. Now, within the S&P 500, there are 493 stocks which essentially have gone nowhere for 20 years. And there are 7 which have carried the entire index higher and higher and higher. And as they have, they account for more and more of the index, to the extent that NVIDIA, the leader of all of them, today accounts for 8% of the S&P 500. We've never in all history ever had such a concentration of risk. So here we sit. This again, come back to what I said at the start. You have crashes and you have concentration of capital, which then when it crashes, that ushers in the new world order to some degree. It brings about conflict. It brings about domestic conflict because people have their life savings wiped out, right? And then typically leaders will in that situation, they'll realize that they're going to lose their head. So they channel that energy towards some external threat, which is why you then have international conflict. But because you don't have the actual dominant prowess to sustain that international conflict, they typically lose the conflict and they become the subordinates. And these are the phases that we're going through, which is why we are watching wars, stupid wars. It's why we're seeing internal domestic conflict. It's why there's a lot of conflict in European Union and across all the countries. It's why there's conflict domestically in the United States. And so these things are likely to accelerate and continue. But the financial side of things is where we're focused because I'm a hedge fund manager. And at the end of the day, you can choose to live wherever you wish to live. However, if you don't have capital, it's very, very difficult, or you live quite a different life if you don't actually have capital. So my job is to look after mine and my clients' capital to ensure that they have the ability then to say, oh, maybe I want to go and live in wherever, but they have the choice to do that. Your choice gets taken away when your financial resources get taken away.
Yeah,
So
bingo. Yeah. What popped Japan in 1989? What happened that the that the tide finally turned on Japan. I'm aware of the story, and I know their valuations. They were essentially 3x the size of their GDP in terms of MSCI market share. Right? You said 45%. The US right now is 5x its GDP, or its percentage of global GDP. So an even more extreme situation. We know we could call this episode "Mean Reversion is a Bitch" because it does come eventually. It does come, and you're a great student of cycles. So I want you to share with people your own thoughts on the commonalities of cycles, end of this empire, end of that empire. We know that these things are going to happen. The timing, in a sense, doesn't even matter. You don't have to play the timing game. But first of all, what happened going back to Japan? What happened in 1989 that finally brought that whole thing down? Times of great political chaos are also times of great investment opportunity. Watching this channel means you're interested in strategies for making and keeping generational wealth. That's why I want to tell you about the guys at CapEx Insider. This is probably the premier financial newsletter for independent investors over the next decade. Why? Because Chris Macintosh and Brad McFadden have a take on what's happening and how to profit from it, ideally suited to the massive shift currently underway all across the globe. For example, Chris understood that the green energy nonsense was just that, so he recommended an offshore oil services company that went up almost 1,000% in a year. That's 10 times your money in 12 months. Chris is one of the best guys in the game spotting counter-cyclical, counter-jurisdictional opportunities long before anyone else has a clue. He told readers to buy Argentina long before it became big news and there was a turnaround coming. His Argentina picks would have already delivered you life-changing money, and that's a situation that just keeps getting better and has years to run. You see, the problem with most newsletters is that you seldom get any interaction with the analysts or a chance to ask questions. Capitalist Exploits Insider lets you look over the shoulder of one of the best hedge fund managers in the world with highly entertaining Q&A calls for a fraction of the cost of paying an actual hedge fund manager. Chris and Brad host regular Ask Me Anything calls and timely video updates where you can speak directly with Chris and his team. That's why CapEx Insider is rated 4.8 stars on Trustpilot, which is practically as high as you can get. Best of all, right now, you can test drive CapEx Insider for 7 days for just $1. Click the link below to get all the details and to join Capitalist Exploits Insider. You can thank me later. Was there an event? Was it something?
Yeah, no, like I mean,
domestic,
the same thing that typically happens, and it's not that that sellers enter the market; it's that buyers no longer continuously buy. So you need to have an elevator. You need to have a continuous trend. Okay, and here's the interesting thing is that you could have essentially theoretically one person that can add many, many millions of dollars to a market cap of a company. One person with one trade, and they could only buy one share, right? Because the way that it works is that the market capitalization, the value that people see in their portfolios, is based on the last active trade. Okay. So think about a house. Like, so people think about a house they might live in. Let's just say for shits and giggles, you bought $1 million house. Okay. And you're in a neighborhood where the houses, it's part of a community, and they're all pretty much the same. Okay. And they're all roughly sell for like $1 million. And your neighbor then sells his home and it goes for 1.2. What happens is, and this happens for the banks and the valuers, and essentially the market says, oh, the prices are no longer $1 million because that one just sold for 1.2. The market's come to the table. It says it's 1.2. So therefore, all of the properties, and there could be 100 of them, are now valued at this new price point that's been reached. And then some other guy could come in and he could be a Mexican cartel lord, and he doesn't care about, he's just trying to like funnel money. He goes, I'll pay 2 because like, I don't care. So now he buys a house for $2 million. Now you have 100 homes, and they all sell with all $2 million homes. Okay. Now, the reason I point that out is you can have one trade that elevates the price. The thing that changes it is actually just no new buyers. Okay, so no new buyers come in. There's no other Mexican drug cartels or lords who are prepared to pay $2 million. Now what determines the price is who has to sell. So the person who has to sell, if there are no buyers at $2 million, he takes what he can get. That price could be any number below 2 million. It could be 800. Remember, that was $1 million, and then it went to 1.2. It could be 800,000. It could be 700,000. It could be any number. And so that, and then when that new trade comes through, that's when people go, holy shit, what just happened? That house just went for $800,000. There was one went for 2 million like 12 months ago. What is going on? Now, obviously, in the housing market, things tend to be kind of more stable. There's less liquidity, yada yada. But in global equity markets where capital moves like that in a blink of an eye, then you just have this retrenchment. And so, and keep in mind that this is holding up, like as the case of Japan, was holding up an incredible bubble. A bubble to the extent where you had a lot of leverage behind it too, right? So people would borrow money to go and buy Japanese assets. In fact, the Japanese were borrowing against their stock portfolios to go and buy foreign assets. So that ended up crashing foreign prices in certain places. Japan was like buying stuff all down the Gold Coast of Australia, and they were buying assets. They were buying banks in the US and everything else, right? So it created this tidal wave of selling, part of it as a consequence of the leverage that was embedded in the system. We have the same structural setup today. So, in a very long answer to a short question, it doesn't really matter what it is that finally stops the flow of capital. But what, as an investor, what you should be concerned about is probability and risk. So you can understand the risk. Now you can understand there is a probability. We don't know if it's imminent, but we know that it's probable, and that is enough for you to take action to protect yourself, because it's a bit like having a house that's in the bush and you don't have fire protection. You know, if you do have a fire that sweeps through and burns down the entire house, it's a problem because it's your entire house gone. It's not just like, oh well, there's a bit of a fix a few the fence got burnt or something like that. It's a catastrophic outcome. And so we have a potential for a catastrophic outcome. And the reality is that most people are completely unprepared for it. Completely unprepared for it because their capital is already invested into these structures. Unprepared because they don't realize even that it is invested into these markets. And then furthermore, most people don't have any capital. I saw a stat the other day with the top 5% in the United States. It was like aggregate income, I think was like $150,000. Net worth was like 1.5. And in terms of current bond yields, that person would need to live on about $48,000 a year. And we know that people are not prepared to live on $48,000 a year who are earning $150,000 with a net worth of 1.5. That's your top 5%.
Wow.
That's horrific. That is truly frightening. But again, go back to cycles of history. This is what happens. Countries get overextended. They believe that prosperity is endless. Borrowing is cheap, and they just can keep living beyond their needs for a long period of time. So structurally, that's where we're at. The interesting thing, Tane, is if you go back to when Japan crashed, the US at the time, in terms of global GDP, was dominant, or was becoming dominant. So and the market capitalization was much lower. So you had, like, the trade was obvious. The trade was sell Japan, buy the US. And if you'd done that back in 1989, I can show you this. I got like the Nikkei versus the S&P. If I can show this.